and away we go.
Upon the breakout, gold's going to make a new all-time highs.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin. Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And as you can imagine, our community is growing extraordinarily fast. Thank you so much. There's a lot to talk about on this episode and in these historic times on so many levels. And on this episode, we have a treat for everyone today. Not only will we be joined by Andrew Maguire, but for some timely updates on what's happening out there in the precious metals market. But we'll be joined also by Mr. Jim Forsythe of Citizens for Sound Money. Please keep spreading the word about this channel by liking, by sharing, and also by subscribing. And if you want to click on that bell notification, you will be notified as these episodes go live. So with that, let's not waste any time here and head over to the UK before we're joined by Jim here. And let's go to Talking Gold with Andrew Maguire. Now, Andy, what happens now that the Basel III rules have kicked off on Monday and are kicking off on Thursday in the US?
Well, thanks, Shane. Yeah, good question. And as we know, on Monday, this last Monday, just now, we're recording this on Wednesday. Basel III NSFR standards came into force for most global trading hubs, of course, aside from London, which gets a 6-month extension really to comply. Although the US actually follows tomorrow, which is Thursday. But due to the interconnectivity of all of these paper markets, the unallocated over-the-counter and cash-settled COMEX markets, look, the US will essentially be equally compliant on Monday. Now, look, why we have covered Basel III in detail, in fact, really, actually, for the last 12 months, we've been focusing on it. In summary, really, what it can be summed up as is really under the new standards, paper gold will be classified as far more risky than physical gold. Hey, hallelujah. And no longer counted as an asset equal to gold, physical gold, or, or coins even for that matter. And this is ultimately bullish for physical gold. And of course, as we've justified before or discussed before, bearish for unallocated gold. Now we'll look at the rationale for this in a moment, but very, very, very short term. People are looking, look at the action, what's happening here? It's Monday, it went down. As we warned, while the unwind of unallocated gold accelerates, and look, we're seeing evidence of this, and you can look for yourselves. Look at the related COMEX open interest reductions. I mean, from 800,000 contracts, and that was lots, that was back in early 2020, to just 450,000 contracts yesterday. That's a 350,000 lot open interest. Look, give an idea of scale. Look, these are just numbers, but look, that's about 1,100 tons of paper gold into, this is the important part, into a $300 price rise. And that's even accounting for the current BIS OPEX gaming into today's Mark the Market event. And, we've always warned about BIS OPEX. It's just one of those times where you're going to see about $1 trillion of derivatives mark to market. And, no coincidence that we usually see these kind of smacks. But this could be the last time. Now, really, so what we're saying is very, very short term. Into this algo-driven mix, this short-term price volatility into such a large cut in overall open interest must be expected, because when you close off a long unallocated gold FX position, it initially requires buying the short dollar leg back to square up this, and that means selling the long to square up this unallocated 100-to-1 gold credit position. And that's all it is, a credit position. But the offset to this heavy foreign exchange gold action is the strong sovereign size spot indexing, which, if you remember, that just simply means locking in the price in the spot market, with real buyers looking, what they're doing is seeking to take physical delivery on a T+2 basis. So you've got one side selling, the other side, real buyers saying, thank you, I'll take it. So each day as this situation resolves, paper market overhang is evaporating. Now, given the 100 to 1 leverage in gold and joined at the hip silver, which is 500 to 1, at the margin, this paper market unwind is increasingly bullish and bodes well for a rally after BIS OPEX today. And of course, we have to wait for the obligatory non-farm payrolls gaming on Friday. But very short term, this heavy action into the options expiry, and as we anticipate into non-farm payrolls probably on Friday, really it reflects the balancing of these two forces.
Andrew, here's a question. Are officials going to be subject to the Basel III rules?
On the face of it, Shane, yeah. But as we recently outlined in earlier episodes, it's not going to be immediate, but they are seeking to take control of the physical market. Let's not forget what is behind this, which will continue to evidence the BIS closing unallocated contracts and associated swaps. However, the most important point is that all their agent banks, that's all the too big to fail banks, and these are the market makers, the bullion bank market makers who have gold accounts with the Bank of England, they're going to have to be compliant. And the BIS is orchestrating this for them. Now, the governing factor is that competing central banks and sovereigns will actually demand physical gold purchased at the London gold fixes. And they're going to need that to be, in the vaults and deliverable before anyone's going to ever place orders. Now, if they don't think that the bullion's there to meet a T+2 delivery obligation, what are they going to do? They're going to actually move. I mean, that's what happens on the SGE. That's what happens on every other physical exchange. What they're going to do, these physical orders will flow out of Loco London into the physical markets and exchanges that are compliant, rendering the current Loco London price setting fix completely obsolete. Clearly, they're not going to allow this to happen. So really what we're saying is after 50 years of containing gold and controlling the paper gold markets, now the BIS needs to get control of the physical gold market. And the only way to do this is to get on the long side of gold before it's revalued. And this process begins now, and it will gain traction into the end of the year.
So Andrew, with all that being said, how do you see gold being revalued?
Yes, Shane, really good question. Let's deal with the revaluation process, shall we? I mean, look, historically, this is going back a bit, but historically gold has only been revalued twice in the last 100 years. And on both occasions, this increase in assets allowed the Federal Reserve to further inflate money supply. Now, the Fed, look, obviously the Fed doesn't hold any physical gold. We know that. It holds gold certificates. The certificates are issued to the Fed by the US Treasury, who claim to hold these unaudited physical reserves. And this is a smoke and mirrors relationship. Now, we've discussed this before, but by valuing 8,133 tons of gold held by the US at just 11, it's priced at 11 billion. I mean, this is 8,133 tons because of the price it's valued at. It allows the Fed to have a paper claim on all this gold at $42 an ounce. Now, the first revaluation by the Fed was in 1934, when the gold price was repegged up from $20.67. And then it was pegged up to 35 cents, which is effectively increasing the gold on the Federal Reserve's balance sheet by 69%. Now, this increase in assets allowed the Federal Reserve to further inflate the money supply. Hey, does that sound familiar? I mean, is history rhyming here? Now, if the Fed, I mean, this is just speculative, but history tends to repeat itself. Now, if the Fed once again sought to mirror this 69% gold revaluation, it's just a question here. That would raise the $42 price to 71 bucks. Now, but based on today's BIS sweet spot, which is actually between 1750 and 1800, technically this would forge the Treasury a Treasury price of $3,000 an ounce. And that still looks too cheap to accommodate Basel III NSFRs, which will expose gold credit positions to a physically settled marketplace. Look, any price differential will be arbitraged by a physically starved market at current prices. Now, ultimately, the COMEX will have to become a delivery market. The evaporation of open interest into Basel III is not a coincidence. And we just looked at those. Look at the scale of that unwind. And as we discussed in our last episode, with Basel III about to value physical gold as a real cash equivalent, is it time for the Fed to revalue these gold certificates to market to accommodate literally trillions of dollars of money supply, but at the same time simultaneously protect dollar hegemony? And we talked about dollar hegemony as being one of the primary drivers here. Now, given competing Chinese and Russian central banks race to exchange their overpriced debasing dollars for physical gold, footprints suggest it is the only option, forcing the BIS to buy gold and to allow a revaluation. So very short term, BIS OPEX is likely to cap gold between $1,750 and $1,800, after which, and that's what's happening today, after which we anticipate a steady rise into a minimum of $2,300 into year end.
Andrew, I think you were one of the first to talk about the Basel III rules, and many, many more people are talking about it. You had mentioned that there are different and many, many different opinions on the effects that Basel III will have on the gold price. Now, just before Jim joins us, can you tell us why Basel NSFR, those standards are bullish for the price of gold and for the price of silver?
Yeah, Shane, let's not forget the whole reason Basel III must be implemented. The objective of this NSFR is to force banks to finance long-term assets with long-term money to avoid liquidity failures, really, that threatened the banking system following the 2007-2008 global financial crisis. Now, given gold derivatives comprise pretty close to 70 trillion, I'm talking about all derivatives here, swaps, futures, forwards, etc. That's 70 trillion of interbank counterparty risk. There's no going back from this directive. Not if you want to protect dollar hegemony. So while there are a lot of differing opinions on the impact of these standards will have on the gold price, every negative spin that we've seen or heard, and I've read, results from these changes being viewed through the lens of a 50-year cash-settled legacy gold market. It's understandable. Now, namely, gold benchmarked against the COMEX cash-settled futures market, which was born out of necessity 3 years after Nixon closed the gold convertibility window in 1971. So the problem stems from the fact that the LBMA and the World Gold Council and the current legacy pricing system, it doesn't differentiate between unallocated gold from allocated gold. There's where the issue lays. So therefore, when we see published basis and co-basis data, which determines how GOFO is set, that's the difference between LIBOR and the gold lease rate, which is what the algos trade off, it reflects this anomaly, and by adding or reducing undeliverable cold open interest, officials governing the price of gold against the dollar have tricked the legacy market players into benchmarking their trades upon it. And it's also the anchor argument for those who argue that Basel III will be bad for gold. So for the last 50 years, one unallocated gold market has been used to hedge the other. I mean, go figure. This was quite evident in the LBMA's recent begging letter, and there's no other word for it, to the Bank of England, which attempted to argue from a risk-weighting perspective that high counterparty risk unallocated gold, which clears a ludicrous 600 tons of gold a day, of unallocated gold a day, paper credit, should under Basel III standards not be segregated from the 1 ounce of cash equivalent tier 1 physical gold that underpins all of this high counterparty risk 100-to-1 unallocated gold position. Now, the problem with the LBMA centric argument is that under NSFR rules, unallocated gold and its associated counterparty risk moves onto the balance sheet of the legacy trading banks, incurring a 85% haircut. So while physical gold when hedged with currency risk becomes a cash equivalent tier 1 asset. So there's the equation. So, but allowing an exemption would be the only way the paper market dilution could continue. But this would defeat the whole rationale for Basel III, namely to eliminate interbank counterparty risk and protect dollar hegemony, which I will continue to say is one of the main reasons. Now, so obviously in all jurisdictions bar London, physical or allocated gold bars and coins have now become segregated from unallocated gold and reclassified from a tier 3 asset, which is the riskiest asset class you can have, to a tier 1 zero weight, really categorizing it alongside cash and currencies as an asset class. So raising funding requirements for unallocated gold means a financial institution would either reduce or exit the bullion business, or, as the Bank of America, I read a couple of days ago, Bank of America put they reckon that either that or it would sustain activity and put more funding aside. However, that argument makes no sense at all. When you think about it, sustaining current volumes of 600 tons of unallocated gold trade per day over and above that of legitimate one-to-one hedging or of financing transactions, it'll just become way too expensive and way too risky. Why would you? Why would you take that counterparty risk? Especially as the BIS needs to take control of the physical gold market and will be happy for a higher price. Furthermore, so really, as unallocated gold liabilities move onto the balance sheet of trading banks into a significant reduction in liquidity, and we just looked at the sort of liquidity evaporation that is granularly evident, it means that unallocated gold will have to be priced higher to reflect realistic physical price demand, supply-demand fundamentals, and if not, it's going to get arbitraged. Which is, again, the reason why forcing the COMEX to become a delivery market, which it has to become. And obviously, the COMEX is not going to go away. It'll just simply morph into what it's supposed to be. So as an example, if we just take an example, rising costs for market participants, it's again another argument. They say it'll be too expensive. Hang on. It'll be determined by the increasing cost of financing precious metals production, yes, but that'll be done without incurring counterparty risk. That simply means that the cost of such financing will have to rise to the extent that these forward transactions can be backed by real hedged physical gold. Well, what do you think that's going to do to the price? And this, all that means is that the end user price of physical gold will have to rise to meet this cost. But there is absolutely no requirement to see 1/3 of annual mine production cleared and hedged in London every day. The volumes of gold cleared every day will dramatically reduce. This is a good thing for the gold market, as paper dilution will dissipate and a true physical supply-demand price will ultimately emerge. So equally, when you think about it, there's no requirement to see a ludicrous 9,300 tons of joined at the hip silver cleared through the LBMA members every day in London. So silver is going to benefit enormously. In fact, it will be the rocket ship because it is deeply, deeply oversold too. So under the covers, the real co-basis, which means the scarcity, tells a story of a mismatch between current prices and physical supply, not paper supply. And this condition has resulted in physical rehypothecations of central bank leased swap gold currently being unwound into Basel III NSFR standards. And so the recent backwardations and co-basis data, it cannot be fudged. And a cold, hard analysis of these two irrefutable inputs currently provides a fair value for a gold price at just over $2,300. Now, correctly measured, the co-basis is actually essentially the measure of the price divergence between the paper markets and the physical market, not, as the LBMA currently view it, paper to paper. And I want to stress, the current 2300 fair value is far below gold's true equilibrium price. This is because the input that measures this fair value is based upon a spot price for gold that is anchored upon the massive unallocated LBMA gold market, which we have hard evidence is at least 92 to 1, if not 100 to 1 leverage against the underlying physical. Now, the reason we've evidenced permanent backwardations, and we have, and you'll see, any technical analyst will tell you, we've seen permanent backwardations when you're accounting for forwards, etc. And even plain vanilla, we're seeing now into BIS OPEX, plain vanilla backwardations, and up to $1.70 yesterday. I mean, that's ludicrous. Look, and we're evidencing this into a historic high real co-basis, which is a physical scarcity. So since March, I mean, that's happened since March 2020. So, and we've noticed that it's because there's a deliverable element to the dilutive, unallocated spot price into contracting paper supply. That's the key element to focus on, alongside the rundown of unallocated over-the-counter gold positions. Basel III has also been the driver for the reduction in COMEX open interest, gradually making it more difficult to maintain this capping, bringing forward the point where the paper gold market must reset higher. This reset is so long overdue. Basel III presents all the components to do this before year end. So buying back swapped, leased physical metal at market is just not an option for the central banks. The mismatch condition is so critical, it's showing up in these permanent backwardations between the cash spot markets and further out futures positions. So bottom line, the co-basis tells a story of a mismatch between current prices and supply. The 50-year aggregation of this condition has resulted in physical rehypothecations of central bank lease swap goals. Hey, we've had so much evidence of this. Just remember, just cast your mind back to the German repatriation requests in 2013. I mean, that provides a glaring example of the fact that there was no gold to repay.
All right, Andrew, I'm positive that our community is excited about everything that you're saying here. And we have a guest now we'd like to bring on, and that is Mr. Jim Forsythe of Citizens for Sound Money. It's exciting to have him on the show, and let's bring Jim on now.
Thanks, Shane. Jim, it's a real honor to have you join us on this episode of Live from the Vault. Look, I've been following you for quite a long time. While you were still in politics and basically ever since. But the one thing is absolutely clear to me, and it's rare. You have absolute great provenance. And with that in mind, I was going to ask you if you could just share a little about your background with us.
Sure. Well, thanks. I mean, the honor's mine. I discovered you guys a little while back and started watching you. That's how I got into Kinesis. Just trying to figure out the silver market. So I went to the Soviet Union as a kid because I studied Russian in high school, and I got to see firsthand what that lack of freedom looks like, and that instilled in me a great love of free markets, and motivated me to join the military to help defend our country. I did such a great job that in 2 weeks the wall came down, and then joined the Air Force. And after about 12 years in the Air Force flying KC-135s, I left the service, started a small business. And then in 2007, I met Ron Paul, and the values that he had were, my values, and I got really excited and campaigned for him. He endorsed me to run for Congress, which I tried for a little bit, but it wasn't going to happen that time around. But then I did run for state senate in 2010, got elected, got some good bills passed like medical marijuana and education tax credits. And then when he came back around in 2012 and ran, I wanted to help him out, so I became his New Hampshire campaign chair. But yeah, Dr. Paul's where I learned about sound money. I understood the freedom aspect, but I didn't understand how, sound money was, it's 50% of every transaction, how vital that is to our freedom. So that's when I really learned that, and that's stuck with me to this day. And that's the battle I'm trying to fight now.
And so did that wall come down because is that why you left the military, because the wall had gone down?
No, well, no, not directly, but yeah, I joked that I did such a good job, the wall came down.
Yeah.
But it was that's kind of the motivation why I joined, and without that, we were involved in a lot of different things, and so I felt like I could be as effective or more effective fighting for freedom on the outside versus within the military.
Well, look, thank you, Jim. For the many years, you've really led the way in drawing the public's attention to sound money. Long before people got involved in perhaps the latest amount of people that got involved with gold, silver, and realizing, that is a key element of it. But long before that, and I've been around a long time, and I think it really is important. That you have led this way, and you've drawn in a lot of interest, and given there's in other words, you've cast that net wider than we would normally in this industry have expected, and given is very little argument, the current banking system is precariously broken. I think there's little argument. Can you explain why sound money is actually important?
Yeah, I put together a few slides that I borrowed. But first off, yeah, and we started up a nonprofit, Citizens for Sound Money, and congrats to you on earning a Sound Money Leadership Award. We were giving out KVTs, the award winners, and I know you passed yours to your son who just got out of the Marines, so congrats to him as well. Thank you,
and he was very appreciative.
Yeah. So here's some charts from a great website, WTF happened in 1971. So the breakdown from the gold standard really started with the creation of the Federal Reserve in 1913, because then they could backstop the banks, and artificial interest rates led to a lot of the Roaring '20s and then the subsequent Great Depression, and then FDR made confiscated gold and then revalued the dollar from $20 an ounce to $35 an ounce. So the breakdown was gradual, but we were on a gold standard till '71, and when Nixon took us off. And you can see what's happened since then. The productivity's continued to go up, but our compensation has kind of stagnated since we went off the gold standard. And if you look at incomes, that gets mirrored. Basically, the bottom income earners have been stagnant since we got off the gold standard. Meanwhile, the upper income continues to make more and more money, and that's because when there's a fiat system, the people, the dollars get created, and whoever gets them first basically makes more money. And that's, the big corporations can borrow near zero interest while we're paying 18% on credit cards.
I mean, this is fantastic. Yeah, and it's good to, it's good to consolidate this stuff. Sometimes, Jim, we look at the short-term charts, we look at short-term information, and don't realize where we've come from. This is really interesting. Please carry on.
This is, we're in the middle of a 100-year cycle, going back to, the Great Depression, World War II, and that big debt bubble in the government, and we're back to that again. But yeah, here's CPI. You look at all those years of the gold standard. There was moments when we went off, like Civil War with the greenbacks. We got some inflation, the Revolutionary War, and you'll see that a lot. The tendency towards fiat is, in war times, it's easier to print the money than actually collect it. But then since we got the gold standard, it's just really gone crazy. And lack of sound money is what has enabled the government to spend more and more money, because they can just print it rather than have to go through the effort of collecting it from people. So you see our GDP as a percentage of, or our debt as a percentage of GDP has skyrocketed. We're at wartime levels. We're at World War II levels, even though it's peacetime. And kind of a hint of things that could happen. I don't think this will happen. I don't think we'll get hyperinflation, because as the world reserve currency, they're going to have to do something before this happens. But you can look at, what happened in Germany to the Weimar Republic. This is a logarithmic graph, and you're seeing a parabola on a logarithmic graph, and this is over the span of 2 or 3 years. So this is the kind of thing, by getting into gold, silver, it's insurance against something like this happening. You can protect yourself against this kind of thing. So that's very quick and dirty why sound money is important. Like I said, it's 50% of every transaction, and inflation eats away at your savings. The people that get it first benefit. while the people that don't suffer. And it creates these big boom bust cycles that have, the Roaring '20s and the Great Depression. So we need to get back to sound money. And I'm one who believes, the government might do the right thing in the end, but there's no need to wait. I think people need to start using sound money today, and that's the reason why I've been so excited about Kinesis, is it's a way that you can use sound money today and not have to wait.
Yeah, do you know, you show, when I'm looking at this chart, and it just really, I mean, it makes you really think, because people look at that and think, that's history. But you know what? Every single European, I mean, I'm specifically talking about Germans, most German people still have a gold savings plan. Almost every single German has a bank account that has a gold savings plan within it. And then what you kind of really look at that chart, and it hasn't gone away. That lesson was learnt, and that lesson is still there, and so that's interesting. And I know that the average U.S. citizen owns very little gold, and really has never really owned very much other than a bit of jewelry, and yet we look at this and we see why. The lesson learned, and it's not gone away. And then we look at the rest of the world, Jim, and you look at the average, even a rural Indian farmer has kilos of the stuff. Yeah. And the average American has what? An ounce, maybe. I mean, just in jewelry. I mean, it's a mind-blowing thing. And I think this is one of the important things, is that you're bringing this with a very US, it's a global view, but it's a US-centric view. And I think you draw this history into what's happening now. And it really gives your head a shake. You have to give your head a shake and say, my goodness me. I mean, look at that chart. What's happening now? You just explained. This is potentially the parabola we're on.
Yeah, and unfortunately, people don't look back at history enough, and their experience is guided by what they've experienced in their lifetime, and we haven't experienced a currency collapse. Like you said, you look at other countries like Russia, had a very recent currency collapse, and they get it, and that's why they're stockpiling gold. So yeah, it's important to learn those lessons from history, and or be defeated, get in trouble with them. And I think that's the fear of what's coming. And yeah, you look at this graph, and it's a parabola on a logarithmic graph. Well, that's Gresham's law kicking in. That's the good money driving out, or the bad money driving out the good, or the good money driving out the bad. It's once this starts, the government can print money exponentially, but once this starts and people start to realize it, then they're dumping their dollars, and that can happen very quickly. And that's why it's important, not to wait for it to start, because when it starts, it can happen very quickly. Instead, start stockpiling some gold and silver, today.
I don't know if everyone knows what C4SM is, but can you explain? Because I know that's a tag you use, but obviously there are a lot of people who will be watching this who perhaps don't know what that is. Can you explain?
Yeah. So we just started up, I think a couple months ago now. It's Citizens for Sound Money. So we're organized as a nonprofit. We've applied for a 501c4 status, and our very quick summary, our goals are to encourage the use of sound money today, and then to protect people's rights to do that. And so far, Kinesis has been the bulk of our effort in terms of encouraging sound money. We're also starting off an effort to get physical into people's hands at a reasonable price. And Kinesis is going to play a part with that. So yeah, we redeemed. There's two different efforts going on, but we redeemed one of these 1,000-ounce bars for Citizens for Sound Money, and we're working with the Mint to get them cast into 10th-ounce buffalo rounds. There's a 1 ounce next to a 1/10 ounce, and it's about the size of a dime, worth $3-4. That's real money right there. So yeah, super excited to be working on that effort. So we view Kinesis as kind of the liquid version. The online transactions, be able to make payments across countries, but this physical silver in your hands is absent counterparty risk, and you can use it for barter and exchange, tipping people.
So these 1,000 ounce bars. Now, I understand that these came through Kinesis, yes?
Yeah, they did. So the redemption, 0.45% redemption fee, plus $100 redemption fee, but we did 2 bars at once. So that's $50 per bar, and then the shipping was $4.25 from New York to where I'm at. So about 60 cents above the KAG price, maybe about 80 cents above spot. So you really can't beat that. In fact, the mint that's going to be doing the coins said, no, we want to use our silver shot suppliers because, you know, they've been loyal to us. Well, they went to go get silver shot, and it was $1 to $1.50 above spot. And, you know, if you want it for $1, you're going to have to wait 4 to 6 weeks. And so he says, well, can you still get those bars? Can you cut them up? Can you turn them into silver shot? So very, very economical for sure.
And I think one of the beauties of that is you're taking, and as this thing progresses, and people can really see that there is an actual 1,000 ounce bar, wholesale bar, which is really what this whole price suppression has been about, the management of 1,000 ounce wholesale bars. It's not been about so much about the coins, it's been about that. And the fact that these bars have been managed so carefully, so to make sure that just in time, the Nokias of this world, the Samsungs, get their silver on time, even if you're unable to provide it into SLV, even if you're unable to provide it to people who want, and look, like as a wholesaler, you have to go in a queue to buy size. If you want size, you have to wait in the queue. You get it, but obviously but as far as the perception is that there's so much 1,000 ounce wholesale bars around, but we know how carefully that managed. Can you imagine if suddenly you had to stop an assembly line at Samsung because there wasn't, or Apple, because there wasn't that gram of silver in time? So, and if there ever was a shortage, and this is where we're heading ultimately, what do you think these guys are going to do? They're going to go out and they're going to buy, stock up. And as they all stock up, suddenly the squeeze, I can imagine the squeeze, but what I love about it is you're physically, there's a picture of the 1,000 ounce bars being sawed up, being taken off the market. They're never coming back. And it really says that. It really sends that message. And I think that's why a lot of people will be so empowered by this. Hey, I can actually do my bit.
So I think you're hinting at our other effort, because you see this on the saw. So one of the members of our nonprofit came to us inspired by Bison Bullion, who has been sawing up these bars. I don't know how many they've done a handful, I think. And he said, we should do this. And I said, well, you know, sawing up a bar into slabs, that's not really money. That's not educational. But that's a great idea for a business. So yeah, we've started a partnership, Silverback Precious Metals. And yeah, we're working on sawing these up. So got some equipment in to do to pouring and casting. We're making stamps. Yeah, that's actually melting down brass, but we'll be able to do silver. And we came up with a little stamp. This is this is a prototype. We've got to fine tune this, but
I love it. I love
Wall
it.
Street Silver folks got involved with artwork. And
I can imagine they did.
yeah, so you love that, tearing up the 1,000 ounce bar.
I love it. Love it because it says, it shows people these bars are never coming back. These are, I mean, we know they don't come back anyway, but essentially, look, that's a great thing.
Yeah, that we sawed it in half. We're working on getting a better saw. And that's about 100 ounce slab that we cut out.
You know, it's history in the making here. You know, it'll be a time when we look back in the rearview mirror, Jim. There'll be a time. This will be the time when we were able to easily get 1,000 ounce bars at this kind of price. There'll come a point where those 1,000 ounce bars they'll be like hen's teeth, very difficult to get, and certainly a hell of a lot more money. And so this is a great project, and very innovative. I mean, really, no one's ever thought of this before. It's a very good idea.
Well, yeah, I mean, hat tip to Bison Bullion for kind of thinking on this first. Our twist is, we're going to do customization of artwork by the community. We're going to make this a real community thing, and we're going to be taking payments in KAG. And from a business standpoint, it's a great business model because we're always 100% long. We either have KAG or we have the bar of silver. And so we carry zero price risk if we do that. We will be selling in dollars, but then we'll have to charge extra or give a discount for KAG depending on how you look at it, because if somebody pays in dollars, it'll take us a couple days to get that into Kinesis to get the KAG. And in the meantime, we carry price risk of, like what you said, overnight you could gap up and limit up, and all of a sudden we've lost money because we accepted dollars. So yeah, I'm surprised more bullion dealers aren't doing this, because it's a great business model. And reason for doing the bars is, as you know, I mean, premiums are through the roof for coins. Well, there's only so much mint capacity, and paying a higher premium doesn't make the coins come out the other side any faster. But we figure we can do this and have really good throughput by, we'll have a couple saws sawing these up. The stamping is fairly quick, and we can offer these to people at a very reasonable price above spot, and have really good throughput. So it's kind of adds to that mint capacity to meet because clear, it's an arbitrage opportunity. There's just huge investment demand. And right now it's just going to marking up the coin premiums, but it needs to be done to increase capacity. And this is a good way to increase capacity.
Indeed, because I mean, we've seen the mints, for one reason or another, saying, well, we're gonna hold supply for a while. I mean, so in other words, it buys time. But this is an immediate solution. This is something that you can actually utilize right away, because sure as heck through Kinesis you can get more of these 1,000-ounce bars, and you can continue. And the more volume you get, the more people that want it, the more you'll generate, the more your business will grow, the more other people, as you say, will get the idea that this is what we should be doing. We should be taking these 1,000-ounce bars out of the market.
What blew my mind is I told Tom Coughlin about this idea, and I'm not sure what I expected, but I think a lot of people would think he'd say, "Oh my goodness, you're gonna take all the ounces out of the vault." He's like, "That's a fantastic idea." He says, "We'll work to get you the 1,000-ounce bars," because actually, most people redeeming from Kinesis, they're not going to redeem a 1,000-ounce bar. They want to redeem for the 100-ounce bars, which are generally more expensive for Kinesis. So, us grabbing the 1,000-ounce bars and sawing them up is great. It helps other people redeem for those smaller bars.
So basically, what I mean, you're obviously we're obviously Kinesis is close to my heart, and it's very important that you've seen the value in Kinesis. And can I ask, how are you using Kinesis for this business, and what are the advantages, the immediate advantages you see?
Yeah, so right now we're definitely using them for redemption. We've got a couple other sources we can get bars from, but so far haven't found anything that is inexpensive to obtain them as this is, plus convenient as well. And then we want to accept payments in like I said, in KAG. So our idea is, we can have people put together an order, and we wait until we have enough orders for one bar, and then we say, okay, go ahead and make your payment. And primarily, hopefully that'll be in KAG. If not, it'll be dollars that we put into KAG, and then we'll have 1,000 KAG then, and redeem it, saw it up, ship it out. And so, customers shouldn't have to wait more than 2 weeks with this, because redemption's a couple of days, and then we cut it up, ship it out. And then, like I said, we're essentially 100% long all the time. It's either we have KAG or we have the bar. We're never happen to sit in dollars and expose ourselves to price risk, and that helps the premiums that we offer them for come down, because if we don't have to carry the risk, we know this is what our cost is, we'll sell it for this, and there's no risk of price movement. We don't have to jack the price up an extra amount for that risk. So it's really a great business model. I hope other bullion dealers start to do this, because I remember that blowout weekend. They were nervous to sell on a Sunday because the futures market was closed and they were hedging. Well, we're not hedging with the futures market. We're hedging with KAG, just staying 100% long. And so selling on Sunday is not a problem.
Yeah, I mean, and in both instances, you're talking physical, and in both instances, you're just, the only difference is you're actually redeeming it and into physical form as opposed to using it, continue to use it as a currency. So it is a fantastic idea. And as you say, eliminating the need to hedge is it's a brilliant idea by using KAG. And silver, as we know, is a very volatile marketplace, as we know, and only because of the paper side of things. But this is a solution. And I was going to ask you. I know that obviously I've done a couple of interviews on Wall Street Silver, and very much supporters of them. Jim, I'm sure you are. Are you as excited about it as we all are?
Yeah, actually, when Wall Street Bets did GameStop, a number of us on Twitter that were active in this area got super excited because we're like, look at what these people did. Just imagine if they turned their eyes to the silver market. I actually tried to get in and make a post. I couldn't get in, but the Happy Hawaiian made that famous silver squeeze post, and the rest is history. There was a lot of clampdowns in Wall Street Bets, and so they started Wall Street Silver. And I joined, the next day or two as soon as I found out about it, and truly impressed with what those guys are up to. A friend of mine, Lawrence Lepard, who's been active in sound money for longer than I have been, told me to read The Fourth Turning, and my analogy is that the generation of Wall Street Silver are the hero generation of The Fourth Turning, where we're on this 100-year debt super cycle, and fiat currency has lasted longer than it ever has in history, and it's coming to an end, and we have this populist uprising. They've embraced PSLV. They're starting to embrace Kinesis and definitely embracing physical. And they're growing by leaps and bounds, and they're having a huge impact. If you look at the flows of SLV outflows versus PSLV inflows, the growth of Kinesis that we've seen in the last two months, and the physical just continuing to fly off the shelves, they're amazing. And price smashes haven't changed it. They just keep growing in strength and in numbers. And I can't say enough good things about that community, and that's why we want to involve them in this effort.
I think the beauty of it is what strikes me is that it has become a movement, and you can't stop a movement. I mean, that is Kinesis. That is what Kinesis is too. It is a movement, but this is what I love about them is that it doesn't matter what happens in fact. Knock down the silver price. And what do you see? You see people saying, hey, come on, let's get some. Let's buy some. When is it going to be this cheap again? I mean, let's face it. The only reason we've got silver at current prices is because of this really associated 50 years of history where we've had the COMEX, we started with the gold COMEX contract 3 years after Nixon closed the gold window, the convertibility window. Silver followed, and ever since then, it's been contained. And I think this is what really gets me. There was a time when you could just simply use psyops, and and being in the military, you know what psyops is. I mean, it's the governments use it all the time. Completely psych everybody out. Just give them a good rinse, and obviously you've borrowed positions from the market, you've borrowed it from the house. They know exactly what your position is. They rinse you out, and they start again. It's been hugely profitable, and obviously silver is used as a mechanism to maintain the price of gold because they're joined at the hip, obviously. But I think what's beautiful about this is that this movement is so much bigger than that because it eliminates the psyops. If there's a discount, people jump in and buy more. They're not psyched out. And I think this is a huge turnaround. And then suddenly you bring in this picture of this bar, sold out bar. I mean, you have no idea how excited this makes me. I'm 70 now. Good God. I'll be around probably the next 30 or 40 years because I'm too excited not to be. But Jim, this is really exciting, and thank you. Do you know what? I just can't thank you enough. I mean, everything we've heard from you today is not only innovative and exciting, but I think but really what you're enabling us to do is you're casting that net out wider, and you're enabling us to all play our part in the movement to promote sound money in all our different ways. And obviously gold, silver is the primary key here, but I just want to thank you so much for everything you're doing. And I mean, I look forward to your daily updates on Twitter. And in fact, it's my first port of call, because when I wake up, I take off do not disturb off my phone. Otherwise, it'd be going all night long. And the first thing I do is, your post is there. And that's the first thing I read before Zero Hedge or any of the other things. You know, what I love about this movement, though, is that it enables us to have a platform where we can take personal responsibility for our actions. That is the key. And right now, silver is your focus. And in my view, it is the leveler. And you clearly have a great handle on it. And I just want to say thank you so much for being that driver and drawing so much attention to it.
Well, no, thank you. That's very kind of you to say. Just acknowledge, Citizens for Sound Money has essentially an informal board that is very active and, does a lot of the work behind the scenes. And then Silverback Precious Metals is a multi-person partnership. So I can't take all the credit for all of this, but great team that we've got.
Yeah, and this is a great day to have you on. The Kinesis yield engine just went live.
I know. I was checking it out, going through all the tabs, and I really love the layout. And I can't wait to see what Citizens for Sound Money has for minting yields. We've certainly done a lot of minting.
That's going to be great. But Jim, thank you so much for your time. But please promise us that you'll come back again. This has been such a blast, and as I say, it's one of those momentous moments where to me, you bring this provenance in, you bring this pragmatic view of everything in, and a lot of it resonates with, I think, a lot more people than as I say, it casts that net out just that bit wider into a much larger audience. And it's people. That's what we're trying to do here. You just showed that chart of the Weimar, and you looked at the inflation, hyperinflation there. This is coming, and this is important that you're getting this message out, and it's going out into politics, and it's going out into a much wider arena. But I think this is very important. And so yes, you are doing your part. Most certainly you're doing your part, because you got my attention. You got a lot of people's attention around that I go, when I go to the pub and I talk about it, they mention your name. So but thank you so much.
No, thank you. Appreciate it.
Wow, what a great episode. And wouldn't it be great to get our hands on some of those physical silver bars? It doesn't matter even the size, but this is incredible what Jim is doing. So there you have it, everyone. Another fascinating episode live from the vault. Thank you so much, Jim Forsythe of Citizens for Sound Money. And of course, Andrew Maguire. Everyone is always excited to hear from you. Listen, be sure to help us spread the word about this channel by liking, by sharing, and subscribing. Get the word out that this is happening. If you want to be notified in real time, just click on the bell notification, and as these episodes go live, you'll be notified. So in the comments, please add to the comments, tell us what you think, and we will see you next time on Live from the Vault. Bye for now.